Hello everyone, welcome back to our channel Wint Wealth. Many of us have spent the past year brushing up our financial knowledge, come up with smart ways to invest our money and make it grow. No matter how much you read, the question still remains, which is the most secure investment option that gives you higher returns? For decades, fixed deposits have remained the preferred choice of investors who wanted guaranteed returns, that is, take zero risks with their money. Well, to be honest, nobody really wants to risk their money, yet higher returns are often led by higher risks. Besides, with interest rates of FDs at a dismal low, it's worth exploring other options that give you higher returns while covering most of the risk. So, what are these options that are we speaking of? Let's look at the usual suspects. There's gold, there's mutual fund, and then there's real estate. I'll not be speaking about them. Instead, I'll introduce you to an investment option that was only available to high net worth individuals up until now. I'm talking about covered bonds offered by different NBFCs or non-banking financial companies, which, as the name suggests, are pretty different from the banks you and I know and love. But we'll come to that in a bit. Speaking of covered bonds, they've performed very well historically and can give you 9 to 11% returns for your investment. In simple terms, you can equate a covered bond to fixed deposit with an NBFC, but it's likely to give you a better return. Of course, both the products are very different and have different risk profiles. But before, you must be wondering about what an NBFC is in the first place. Let's speak about that. NBFC, or a non-banking financial company, as the name suggests, is not a bank. They are financial companies that don't have a banking license but can perform various functions which are also performed by a bank. Interestingly, the way they earn money is also pretty similar to that of a bank. Let's break this down. What has happened here is that you've deposited your money in a bank for an interest rate of about 3 to 5%. The bank then lends the same pool of money to someone else at an interest rate of 10 to 12%. And the difference between these two interest rates is what the bank gains. This is just one of the ways that banks make money and is pretty similar to what an NBFC does. Then the natural question is, how is an NBFC different from a bank? Well, there are two fundamental things which differentiate an NBFC from a bank. Banks can accept demand deposits, but NBFCs cannot. But didn't we just say that NBFCs accept deposits and lend them further? Well, yes, they do, but unlike banks, they don't accept demand deposits. In layman terms, we are referring to current accounts and saving accounts. When you put your money in a savings account, you can access that money anytime you like. Such deposits usually earn very low interest rates. NBFCs, on the other hand, don't accept demand deposits. They only accept public deposits for a minimum of 12 months to a maximum of 60 months. Regulation is another point of difference between banks and NBFCs. While banks are very strictly regulated by RBI, this is not the same case for the NBFCs. The reason is banks are entrusted with public savings. That is, the money parked by individuals that can be withdrawn at any time. Now that we are familiar with banks and NBFCs, why should we go around and invest in covered bonds which are issued by these NBFCs? Frankly, for the same reason that you would invest in secured bonds. Security of returns. A secured bond is considered safer than an unsecured bond which is backed by some form of an asset. This gives you peace of mind that your investment is safe, and even in case of a default, your money can be recovered through the pool of assets. But are secured bonds actually really secure? Theoretically, yes. But do you really know what happens when a secured asset is sold? A long line of creditors, including the government, needs to be paid off before investors like us see our money. So technically, you'll receive your money back, but when you'll get it, that's a looming question and risk that you must be prepared to take. Now let's see what changes with a covered bond. A lot, to be honest. So a covered bond is backed by a pool of assets just like a secured bond. These assets can be gold, property, or anything of value. However, unlike a secured bond, a covered bond issuer transfers these assets to a third party or an independent trust which holds them. You can imagine an NBFC wants to raise, let's say, 20 crores. The NBFC will tie up with a platform like Wint Wealth, which buys the primary issue of covered bonds and then sells it to the investors on their platform. So let's assume that Wint Wealth decides to buy the entire issue. But Wint Wealth wants to ensure that their investment is secured. In this case, Wint Wealth buys the issue which already had an SPV set up. This issue is then made available to individual investors in the secondary market. The SPV is a separate entity managed by a trustee who acts on behalf of the investors. Therefore, if an NBFC goes bankrupt, the money can be recovered from the SPV out of the same collections which were received from the underlying pool that the NBFC submitted. The SPV sells the loan to recover the money, or even sells the houses or the secured asset to recover the cost. Here, unlike the secured bonds, we are right in front of the queue. Now let's summarize the whole video by asking ourselves, why should we invest in covered bonds which are brought to us by WintWealth? Well, there are many reasons. Let me count them for you. Potential for higher returns than fixed deposits, bankruptcy remote bonds, which means that no matter if NBFC goes bankrupt, you will get back your money. You can start investing for as little as 10,000 rupees. Number 4, tax benefit. The smart people at WintWealth have structured these bonds as MLDs, which are very tax efficient. Therefore, even though they are debentures, they are treated same as equities and are taxed at a lower rate. Number 5, increased liquidity compared to other covered bonds. Usually, it's pretty difficult to liquidate covered bonds. But when you buy from WintWealth, you can sell it back to WintWealth, and if there's a buyer available, we'll make sure that you're able to sell it to another person. Otherwise, it's usually pretty difficult to liquidate these covered bonds. Now, let's take a step back, because it's worth remembering that covered bonds fall under high risk, high return category, which means it's always advisable to diversify your investments across different NBFCs that WintWealth works with. Well, that's all for today. Hit that like button and don't forget to share and subscribe, because we'll be coming up with more such videos in the future. Till then, happy investing.